Hey, welcome back. It's Lepage from Mortgage 360, and today we're discussing Lepage and their prediction that housing prices are going to increase nationally by 5.5% in 2021. And I want to discuss specifically why different economists are predicting different things for the economy. I also want to discuss why there's this increase in housing prices during a pandemic. And then at the end, I want to give you a little bit of my own predictions. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button for the YouTube algorithms so more people like you can see this video. Okay, so let's get into it. Let's talk about Lepage's predictions. Greater Toronto area, they're forecasting to go up by 5.75%. This is already after a record year of housing price increases there. They're expecting that Ottawa prices are going to go up by 11.5%. This is because of government and tech sector expansions. They're predicting that the priciest city in Canada, Vancouver, is going to go up by 9% in value. And then they're predicting that Halifax and Greater Montreal are going to go up between 6 and 7.5%, and that Calgary and Edmonton are going to buck regional trends. Yes, they're referring to the oil industry there, and have modest price growth, which I think is probably a pretty fair assessment of Calgary and Edmonton. Now, let's talk for a second here about the difference between this report and what CMHC has been saying, because CMHC has been predicting a lot worse than what Lepage is predicting. And the reason for that is because different economists are paid by different people, and their economic predictions are going to be dictated by who's paying them. So obviously, a company like CMHC is hiring economists to help them figure out what their worst case scenario is, because CMHC is an insurer. So what they want to figure out is, if everything goes absolutely wrong, what their worst case scenario is and how much money they need to be able to have on hand in order to pay out insurance claims. So obviously, an economist that works for CMHC is going to have a trend towards the negative a little bit more than somebody who's working for a company like Lepage. Now, Lepage obviously is paid. It's a for-profit company based on positive things happening in the real estate market. So their economists are going to tend to predict more positive aspects, because as Lepage puts this sort of information out to the real estate network, they want to give off a positive vibes that hopefully that becomes a self-fulfilling prophecy and their agents sell more houses and make more money, right? Because I don't know if you've ever been in a real estate office, but in real estate offices where people are really upset and really sad about how bad the market is, nobody makes money. But in markets where they see opportunity and they see that there's an opportunity to make more money, things are usually a lot better and a lot more positive. So really what you've got is you've got two different types of organizations predicting different things because they've got different motivations. And then you've got banks that are kind of going right down the middle saying, hey, we see that the economy could get worse and it could get better. We don't know yet. There's vaccines coming, and they're kind of predicting a pretty flat market. And here's the thing about economics is it's not the predictions that dictate what's going to happen in the economy. It's the things that surprise you. It's the things like a pandemic or a financial crisis that dictate where the market's going to go, and nobody ever expects those things. So really what's going to happen in 2021 with respect to real estate markets is, well, we have no idea. And something will surprise us. The market will either get really good or it might get bad, but we won't know until we know. But what we can talk about with certainty is how we got here, because nobody expected in March that we'd have a pandemic. And when we found out about the pandemic, nobody thought for a second that we were going to have a market that got hotter. Everybody expected that the market was going to cool down. And in fact, at the beginning of the pandemic, I was wondering how I was going to be able to keep people employed. Now, obviously, interest rates got lower and the market's changed, and now we're in the situation where we've had record sales in a year that nobody expected us to have record sales. And the question is, what's the reason for that? Well, the answer is we've had a shift in where people spend their time. So you know how Starbucks always wanted to be the third place, right? People had home, work, and Starbucks. Well, Starbucks, when we're able to go back there, is going to quickly become the second place, because work and home are merging into one place. And that's why you're seeing this shift in the economy, this shift in the real estate market, and increases in housing prices, is because people are now working from home. Employers are understanding that employees are actually more productive when they're at home. And the employees that are working from home are realizing, especially if they have a spouse that works there as well, that they need more space, because being at home with another person who works is really difficult. And what that's done is created this movement towards bigger houses. Now, obviously, movements towards bigger houses don't happen without some added affordability. So obviously, there's some things in the economy that have assisted this. One is, for the most part, high-income earners haven't experienced the same interruptions in income as lower-income earners, so people who work in hospitality and tourism industry. And for those who have had uninterrupted incomes, they've found themselves paying lower interest rates on mortgages. And what that has done is it's allowed them to have greater purchasing power. That's why somebody who is living in a medium-sized house is able to buy a large house right now. It's because the lower interest rates are allowing them to stretch dollars further. So subsequently, what you see is in different markets, there being a seller's market for high-end homes and bigger homes in the suburbs that are closer to things like the mountains or lake country or wherever. And that is what's really been fueling this economy. And what Royal Lepage is saying and what they're seeing is that that fuel is going to continue into 2021 because there, quite frankly, hasn't been enough supply of those slightly bigger homes to fulfill the demand. And I think in a lot of ways that Royal Lepage is bang on with respect to this outlook. Now let's talk about the opposite opinion, because CMHC definitely didn't see this coming. In fact, they were predicting that we would see an 18% decline in housing values over the course of 2020. Didn't happen. And that's the thing about economics. It's always the thing that nobody saw coming that surprises. Now, I think CMHC had good reason to expect that housing prices would go down because obviously they saw that there was this pandemic, there was all these deferrals, right? The national rate for deferrals was around 9%. It's now 5%. That's not because less people need deferrals. That's quite frankly because people ran out of time on deferrals. And only time is going to tell how many of those people who are in deferrals and who have had interruptions in income are going to find themselves in foreclosure and bankruptcy. But for the most part, what it's looking like right now is that the economy, while smaller, is still pretty stable for the majority of people. And as we start to see vaccines rolling out, we're going to see more and more confidence in the economy. I know that friends of ours who work in the medical field are getting vaccines as early as the 20th. And as more and more people get those vaccines, things are going to look more and more positive. And as things start to look more positive, people will start spending more money. Obviously, low interest rates are going to be here for a very, very, very long time because obviously as the central bank starts to increase interest rates, if they do so too quickly, it will create a self-fulfilling prophecy where people can't afford their payments and therefore the economy will end up back to where we started and where lower interest rates are needed again. Now, one thing that I'm not sure that Royal Lepage has considered in their 5.5% increase in price forecast is that as we see more and more foreclosures come on, and there are going to be some foreclosures, not everyone is going to get saved, is that could add supply to the market and therefore that added supply could basically balance things out. So here's my prediction. I don't necessarily think that CMHC's doom and gloom is the right prediction, and I don't think that the rosy picture that Royal Lepage has basically painted is going to necessarily be an accurate prediction, but I think we're going to fall probably somewhere in the middle. Or we could find ourselves having some massive surprise in the economy where housing prices go up a massive amount in 2021. We could also see a surprise on the downside and they could go down substantially. But at the end of the day, here's what's important for people who are buying homes to live in right now. 25 years from now, when your mortgage is paid off, 2021 is just going to be a blip on the radar. Whether you bought at the top of the market or the bottom of the market in 2021, it doesn't matter because at the end of the day, 25 years down the road, your house is going to be worth substantially more than it is today. And that will be a good investment as long as it's a property that you've bought that is within your means, that you can afford to pay for, and that doesn't have any massive issues with it. So here's my message for home buyers in Canada in 2021. Buy the house that makes the most sense for you and that is financially within your ability to pay for it. If you do that and you continue to be able to make your payments and you don't have any interruptions in income, you're going to be very well off 25 years down the road. Don't think for a second that staying out of the market is a good idea, because if you're expecting a crash to happen, you may not see it. Look at CMHC. They expected an 18% decline in prices. Didn't happen. Don't let that be you. And if you think that housing prices are going to increase and therefore you're going to go and buy a whole bunch of property, well, you might find yourself on the bad end of that prediction as well. I certainly would not be buying any properties on spec that aren't going to be built for a year or two down the road. That's definitely going to be the type of speculation that gets people in trouble because we have no idea what tomorrow looks like. And the one thing I can tell you about 2021 is it is full of uncertainty because 2020 was full of uncertainty. Trying to make predictions and time the market is going to be dangerous. It's going to be the thing that gets people in trouble. And ultimately, speculating is the fool's game. So if you found this video useful, if you found it interesting, do me that favor, hit that subscribe button, hit the notification bell, and please hit that like button so more people like you can see this video, and tell me what you think is going to happen in housing prices in Canada in 2021 in the comment section below. Cheers, we'll see you on the next video.